I want to welcome everybody here for a conversation at Brookings at the Center on Regulation and Markets. I'm Aaron Klein. I'm a fellow in economic studies and the policy director here at the center. I'm sure that everybody in this audience, and frankly, everybody in America, has been talking nonstop about broker deposits for all of 2019, starting when the FDIC put out their advance notice for public rulemaking and started soliciting comments. And in point of fact, I make this joke because this is not on the front page of the papers. This is not on the bubbling lips of the chattering class. But this is very much the type of issue that changes in regulatory policy can make that can have deep and profound consequences. And it's why Brookings established the Center on Regulation and Markets, and why I believe its work is so critically important. Because particularly in today's political and complicated regulatory and legislative environment, it is precisely changes to regulations like this that have significant consequences for the future of the financial system and for, consequently, deep impacts on everyday people. I think most people don't appreciate, and frankly, to be slightly honest, I didn't either until I started reading all of the wonderful comments that came in through this process, how many brokered deposits I have. I didn't realize that my health savings account little debit card was a brokered deposit. I didn't realize that the prepaid card gifts that I get and receive this time of year are often brokered deposits. I didn't realize when I talked to folks who said they had bank accounts and when you really broke it down had fintechs or broker-dealers that swept their money that they were considering and falling under this rule of brokered deposits. In point of fact, often my view of brokered deposits was what I'd learned 30 years ago, 20 years ago when I started in this space, which is based on the financial crisis or the banking crisis that wasn't quite the last one. We all focus on the last crisis and then we forget all the other ones before. History's shown one thing. It's rarely the same crisis twice in a row. But a couple ones ago, the savings and loan crisis, which those of us of a certain age are old enough to remember at varying degrees, and was a really big, it was the greatest banking calamity anybody was ever going to see in their lifetime, featured a large role of broker deposits, and there was a series of regulations after that. And in the intervening time, the world has changed a bit. And the FDIC has chosen to look at this issue, solicited comments, and I think we're going to hear from Chair McWilliams kind of some of the thoughts and ruminations and where the ball has moved on this in a way that is going to touch everybody in this room. It's going to touch everybody in America, and probably, honestly, isn't going to end up ever on the front pages of the newspapers. That's precisely the type of regulation that is important to have an open and honest and public conversation about, feature diverse views, and hash through and make improvements. With that, it's my great honor and privilege to introduce Chair McWilliams. For those of you who've not heard her speak, I wonder where in the banking world you've been, because she's been everywhere. She is an amazing personal story, but couples with it what I want to give is just a amazing whip-smart analytical insight and ability, in my experiences with her, to cut to the heart of an issue immediately, to see arguments that make sense and to probe, to see arguments that are self-serving and fallacious and swat you down pretty quickly. Whenever you go in to talk to the chair, you better be on your A+ game, and even then, you'll be on your toes. Beyond that, I just want to thank her for taking the time and opportunity to engage with us in all of this on a rule that I think is incredibly important and is indicative of her leadership at the agency. So with that, I'd like to welcome Chair McWilliams to the stage. The floor is yours.
So when Aaron talks about remembering crisis from 30 years ago, I feel like saying, okay, boomer. But then I remember that we're very close in age, and I decided not to. Thank you for having me here today, and it's always a pleasure to be with you, Aaron, and it's an honor to be at Brookings as well. As a kid growing up elsewhere, I could have only dreamt of standing here, but I do remember when I first came to DC just being enamored by coming to listen to different sessions at Brookings and thinking what a venerable institution, so it's a privilege to be here today. I will talk briefly about, it's not that brief, about broker deposits today, and I have generally abstained from giving major policy speeches in general. Why? Because I think it was warranted for me to spend some time at the FDIC, digging deep to understand why do we do things the way we do them. And this is actually one of my first major policy speeches where I'm actually laying out some of the groundwork for what we are looking to accomplish, and hopefully with your help. On April 29th, 1982, the superintendent of bank for the state of California closed down a bank in San Diego by the name of Pacific Coast Bank. Do you remember that one too, Aaron? Yeah, all right, good. Not a boomer. In the 4 months prior to failure, Pacific Coast Bank, despite a capital position of less than $200,000, acquired more than $5 million in broker deposits and booked more than $5 million in loans. The majority of the new loans were fraudulent and resulted in jail sentences for the individuals who controlled the bank. The bank failure ended up costing the FDIC approximately $5 million. More famously or infamously, and far more costly to the FDIC, was the story of Penn Square Bank, a one-office bank based out of a shopping mall in Oklahoma City that was closed a few months later. From 1977 to 1982, Penn Square Bank grew dramatically from around $30 million in assets to more than $400 million. The bank focused on oil and gas loans, many of them notoriously poorly underwritten, and many of which it sold to upstream banks. When oil prices began to fall, the bank suffered large losses. Prior to January 1982, Penn Square maintained only a moderate level of broker deposits, around $20 million. However, between January and July, the brokered deposits at Penn Square increased to $282 million. Even as the condition of the bank deteriorated and local depositors pulled their money, Penn Square continued to churn out loans. On July 5th, the Office of the Comptroller of the Currency, notice not an FDIC bank, closed the bank, and losses to the Deposit Insurance Fund ultimately amounted to $65 million. The failure of Penn Square Bank shined a spotlight on the use of broker deposits, prompting congressional hearings and regulatory scrutiny. It was one of many bank regulatory issues Congress and regulators debated as hundreds of banks and thrifts failed across the country over the next few years. Many of these institutions exhibited a similar pattern: rapid growth in risky, poorly administered, low-quality assets, fueled by broker deposits, followed by attempts to, quote, grow out of their problems, end of quote, by adding more of both. This was an era before minimum capital rules, when banks could operate with very low or even negative levels of capital, but continue to stay afloat. I'm fortunate I wasn't the chairman during that time. Bill Seidman was, and he had a whole building now named after him. When these so-called zombie banks failed, it was very costly to the insurance fund. In 1989, Congress acted by, among other things, amending the Federal Deposit Insurance Act by adding Section 29, which generally prohibits the acceptance of broker deposits by banks that fail to maintain a minimum level of capital. Congress addressed the specific problem present at both bank failures I just described: the use of broker deposits by troubled institutions to fund rapid growth in low-quality assets. The statute mandates that the FDIC use a blunt tool to address an important policy problem. The law permits the unlimited use of broker deposit funding for banks that are well capitalized, but completely cuts off banks from all broker deposit funding once capital falls below a certain level. Yet, this is when banks are most in need of a stable source of liquidity to try to right the ship. While some 500 banks failed during the recent financial crisis, many others that experienced trouble were able to stabilize and survive at no cost to the Deposit Insurance Fund or the taxpayers, frankly. Meanwhile, the language used in the statute has led to many questions regarding what is and what is not a broker deposit. The statute defined a deposit broker in a manner that some have interpreted very broadly and others more narrowly, and provided 9 exceptions from this definition, including one, the primary purpose exception, that some have interpreted very broadly and others, again, more narrowly. The FDIC historically has interpreted the term deposit broker broadly, with notable exceptions, and has interpreted the primary purpose exception narrowly, again, with exceptions. Since Section 29 became law in 1989, the industry has changed dramatically, and it continues to evolve today. In the 1980s, business communicated through phones and fax machines, and bank customers typically deposited money and accessed banking services by walking into a local bank branch. The term broker deposit was commonly understood to refer to a specific market in which third-party brokers gathered and pooled funds and placed them in brokered CDs issued by banks. Since then, the emergence of the internet and other technological innovation has fundamentally changed how banks interact with their customers. While some depositors still walk into a local branch, many customers now access banking services solely through the use of internet or smartphones. And today, customers are increasingly utilizing channels such as prepaid cards and third-party fintech apps. Bank accounts are increasingly available to customers through partners or affiliates of banks. A prime example is so-called sweep accounts, which emerged around the early to mid-2000s, in which broker-dealers sweep cash balances that are not invested in stocks and bonds into FDIC-insured bank accounts or money market funds. Additionally, regulatory changes such as the repeal of interstate banking restrictions have increased competition for deposits in markets throughout the country. As the banking landscape has changed and the permutations of how deposits are structured and offered have expanded, the FDIC's broker deposits regime has struggled to keep up. For years, the FDIC faced difficult questions regarding whether different types of deposit arrangements should be reported as brokered. The FDIC responded to each of these questions on a one-off basis, typically through confidential letters or public or non-public staff advisory opinions. The result was the development of a fragmented, opaque legal regime that exists outside of the FDIC's public-facing regulations, understood by only a select few. It reminds me how my good friend Randy Quarles described the Federal Reserve's treatment of control under the Bank Holding Company Act, which he said was understood only by those with, and I quote, because I could not come up with this on my own, a long apprenticeship in the subtle hermeneutics of Federal Reserve lore, receiving the wisdom of their elders through oral tradition like the tribes of Orinoco. If English were my first language, maybe I would have a greater appreciation for subtle hermeneutics. But I suspect many of you will need to look up where the Orinoco is too, and some of you will have to look up the word hermeneutics as well. Nonetheless, it seems like a suitable description of the FDIC's brokered deposit regime, and I wish I could have come up with it on my own. You should know better than to play Trivial Pursuit with Randy Quarles. In 2015 and 2016, the FDIC issued a set of FAQs in an effort to more clearly explain the agency's interpretation of Section 29 and how its interpretation applied to different types of deposits. While this was a commendable effort to provide more transparency, it did not address many of the underlying interpretive issues and inconsistencies that had arisen over the years, and many firms continue to operate under individual non-public advisory opinions. In December 2018, 6 months after I became chairman, the FDIC issued an advance notice of proposed rulemaking seeking comment on how to update and modernize the broker deposits regime. I promised to undertake a comprehensive review of changes to the industry and the FDIC's regulatory policy. After receiving more than 100 comments, which apparently Aaron read individually, in a year of closely studying changes to the industry, the FDIC board will vote tomorrow on a proposal that establishes a new framework for regulating broker deposits. That new framework was designated with 4 specific goals in mind. The first goal is to develop a framework that encourages innovation within the industry and allows banks to serve customers the way customers want to be served. The approach is intended to reflect how consumers want to access banking services in 2020 and beyond. The proposal will clarify that various types of existing partnerships in which a consumer maintains a direct relationship with a bank generally would not result in a brokered deposit. Since becoming chairman, I have prioritized establishing a regulatory approach that encourages rather than stifles innovation. Striking the right balance in how we interpret the broker deposits statute is key to this goal, as we seek to remove regulatory hurdles to innovative partnerships between banks and non-banks and avoid discouraging banks from offering products and services through online and mobile channels. The second goal is to take a balanced approach to interpreting Section 29 that tracks the letter and spirit of the law. For example, the statute provides that an entity is not a deposit broker, and thus deposits it places are not broker deposits if the entity's primary purpose is not the placement of deposits at the depository institution. Under our proposal, the FDIC would analyze whether the primary purpose exception was met by looking at the business relationship between the third party and the customer for whom it is placing or facilitating the placement of deposits, consistent with the plain meaning of the statute. The third goal is to minimize risk to the Deposit Insurance Fund and to ensure we address the core problems Congress sought to address in passing Section 29. In furtherance of this goal, under the proposal, brokered CDs would continue to be treated as broker deposits under the proposal. These were the specific product members of these were the specific products members of Congress explicitly referred to when debating the legislation, and they continue to compromise. I think I put contacts in the wrong eyes this morning, to comprise a large portion of the broker deposit markets today. Brokered CDs are used by some investors to place money in a number of FDIC-insured accounts, thus receiving FDIC insurance on large sums of money by spreading our deposits to stay within the $250,000 statutory limit at each institution. Separately, the FDIC is also considering changes to its deposit insurance assessment pricing to address concentrations in funding that are correlated with higher losses to the DIF. This could include unaffiliated sweeps that qualify for the primary purpose exception under the proposal and certain listing service deposits, which in many cases are not considered brokered today. The changes the FDIC is considering to its broker deposits regulation should not be interpreted to mean the FDIC is ignoring the potential risks associated with different forms of funding. For large banks, a modification to address these types of funding concentrations is one of several changes the FDIC is considering to make its pricing more risk sensitive. The fourth goal of the new framework is to establish an administrative process that emphasizes consistency and efficiency. First, our proposal would establish an easy-to-understand, bright-line standard for determining whether an entity satisfies the statutory definition of a deposit broker or not. Second, it would establish an application process for implementing the primary purpose exception. Today, when a new product is developed and an institution wants to know whether to report it as brokered, there is no established process for making such a determination. At times, requests to the FDIC for clarity have lingered for years. Meanwhile, there are certain types of deposits that some institutions report as brokered and others do not report as brokered. We intend to establish a more rigorous process to give institutions clear, timely feedback on whether deposits should be reported as brokered or not. Those are our four goals. Optimizing for all of these goals is challenging, and we look forward to feedback on the proposals if approved by our board tomorrow. The new framework is still somewhat complicated, but this is the inevitable result of an ambiguous statute that was written in a very different era. It is, of course, up to Congress to decide whether and when a holistic review of the broker deposit statutes is warranted. But if Congress were to undertake such a review, and I was asked about it at a hearing last week, so I feel compelled to offer a suggestion. They should know better than to ask questions. There might be better ways to accomplish the worthwhile public policy goal Congress intended to address. One option to consider is replacing Section 29 of the FDI Act altogether with a simple restriction on asset growth for banks that are in trouble. This would be a far easier regime for the FDIC to administer, would at the very least limit the size of the FDIC's potential exposure, and would more directly address the key goal of preventing troubled banks from using insured deposits to try to grow out of their problems. A simple limitation on asset growth would also be more durable and should retain its effectiveness as the industry evolves and as banks change the way they attract deposits over time. If Congress were to choose not to replace Section 29 altogether, they shouldn't ask me. And instead, if they choose to maintain a statutory restriction on broker deposits, Congress could consider repealing the primary purpose exception, which puts the FDIC in the challenging position of trying to decipher the purpose of every potential deposit broker in the country and replacing it with a more flexible exception based on actual risk to the DIF. Congress could also consider allowing more flexibility regarding when and under what circumstances broker deposits are prohibited or restricted. If Congress chooses to tackle these issues, the FDIC stands ready to provide assistance, although they may not want us after today. In the meantime, we will implement the law as it exists today. The proposal the FDIC board will vote on tomorrow is the next step in that process. According to the FDIC's most recent national survey of unbanked and underbanked households, more than 20 million Americans live in households in which no resident has a checking or savings account at a bank. Yet approximately half of these individuals own or have regular access to a smartphone. Meanwhile, many banks located in low-income areas, including a number of minority depository institutions, depend on deposits sourced from outside their local areas for funding. The changes we are considering to the broker deposits regulation are intended to help such individuals and such firms, and they are intended to provide more certainty and less opaqueness to the regulatory framework. Thank you for your time today, and I look forward to the questions you may have later. Thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.